Hello students, today we will be discussing one new area, that is weighted average cost of capital. You might have seen my other lectures where I have discussed the basic concept of cost of capital, then this preference share cost of capital and cost of debt capital. Today we will be discussing the weighted average cost of capital. As you have been discussing regularly, that is the composition of capital structure taking together cost of equity, cost of debt, cost of preference shares, cost of retained earnings. So in your capital structure, as we have been calculating the individual source of fund cost, taking together organization as a whole, what will be the weighted average cost of capital that has to be taken into consideration. Why the concept of weighted average cost of capital? Ultimately, every fund has some cost. Organization as a whole, one way your individual source of finance in your capital structure, their costs are different from different sources. At the same time, the weight of your this total capital structure, different source may not be equal. As you have been telling that suppose your 1000 is the capital structure, may not be necessary that your four sources all equally, that is 25% weightage. So that is not there. That means you do have two different things. One is your cost of capital from source wise different. At the same time, your weights are different. So taking together, if you make the weighted average cost of capital, you can compare that the individual source of capital, what is the cost of capital? If you take together weighted average cost of capital, all different sources, you can take for your decision purpose. It will be easy for you how a individual source differs from your weighted average, whether it is plus side or minus side, so that you can see for your decision purpose. So in order to give you the detailed idea about your weighted average cost of capital, today we brought one example, one problem where all the types of varieties will be available. That is cost of equity, cost of debt, cost of preference shares, cost of retained earnings. So everything will be available under one problem. So this you can see as a master problem for your any type of problem. For that, whatever problem comes, it will go this way or that way route. So you have to understand this problem properly. So in this particular problem, we are showing that determine the cost of capital of Best Luck Limited using the book value and market value weights from the following informations. You see that you know that book value, that is the balance sheet value, and every time that what is the market value of that. Just say what is the market value of shares like this. So two values will be there. So your source of fund, book value and market value. Equity shares 1 crore 20 lakhs book value and market value 2 crores. Retained earnings your 30 lakhs, market value nil. Then preference shares 36 lakhs your book value and 33 lakh 75,000 market value. And debentures, that is debt capital, your 9 lakh your book value and 10 lakh 40,000 your these things your market value. So you see that what we have been discussing here, all the four sources of capital here from here: equity share, retained earnings, revenue shares and debentures. Now you have to see that what are the conditions given in your problem before solution of the same. So additional informations under equity. Equity, what they are telling that equity shares are quoted at 130 per share. You see that quoted value are 130 per share and a new issue priced at 125 per share will be fully subscribed. So new issue price is 125, but quoted price is 130 rupees. And what will be the flotation cost? Flotation cost is your 5 per share. So under equity share, these are the informations. Dividend. During the previous 5 years, dividends have steadily increased from 10.60 to 14.19 per share. Dividend at the end of the current year is expected to be rupees 15 per share. You are expecting that dividend. Under preference shares, what are the conditions they are telling? 15% preference shares with face value of rupees 100 each would realize 105 per share. So what is the face value 100? The realizable value will be 105 net proceeds, what we can call. Debentures. The company proposes to issue 11-year 15% debenture, but the yield on debenture of similar maturity and risk class is 16%. Flotation cost is 2%. Here also you have to carefully understand that the company proposes to issue 11-year 15% debenture, but the yield of the debenture of similar maturity risk class is 16%. So your rate is 15%, market expectation is 16% or market rate. So flotation cost is 2%. Another information they have given, the tax, corporate tax is rate 35%, ignore dividend tax. So these are the informations available before you. So now as we have to calculate the weighted average cost of capital, they have been asked you using the book value of the shares. So we will be starting for these things, how we can start with the weighted average cost of capital. So one portion we can erase it and let this be, that informations would be available with you. So what are your solutions will be? You see that weighted average cost of capital solutions purpose, two different ways we will be doing for these things. Calculation of weighted average cost of capital by using book value. You know that book value, how much is there? It is there. Book value, weight. You see, in our problem, we have given two types of values. One is your this book value and market value. So first we will start with book value. Particulars, book value, rupees, weight, rupees, and cost, K, cost of capital, weight, W, and weighted cost. Right? So particulars, under that we will tell this your equity shares. As you have shown that book value was 1 crore 20 lakhs and preference shares 30 lakhs, and your retained earnings, no, this is retained earnings. Retained earnings, your 30 lakhs, preference shares, your 36 lakhs, and your debentures is 9 lakh. So your 1 crore 95 lakhs is your total capital. So out of that it is the different way. So what is that weight? If you have to take 1 crore 95 lakhs is your 100%, that is 1, then what will be the percentage for that? 120 by 195 by percentages, that is weight will be 0.615, that is 61.5%. 30 lakhs by 195, that is 0.154, and 36 lakhs by 195, this will be coming to your 0.185 weight, and this 9 lakh by 195, it will be your 0.046. If you add 615, 154, 0.185, 0.046, this will exactly come will 1. So out of 1, what is the segregation? That is the out of 100 also you can take it, out of 1000 also you can take it. But since we are taking here percentage concept, out of 100 we have to take it. So full amount, 1 is these things. Then now cost. That means this various costs you have to calculate. Then weighted cost, so you can weight multiplied by cost, that will come here. So how we will be doing for these cases? You see that weighted average cost calculations purpose, what we have to do? We have to do that. This is the formula wise we have to make it. First we have to make it your equity shares. So equity shares, this will be actually your working notes. So under that, cost of equity equal to D1 by P0 minus F plus G. What is that? KE? KE equal to your cost of equity. D1 equal to your expected dividend per share, and your P0 equal to current market price, or new issue price, right? F equal to your flotation cost. And your G equal to your growth rate. Okay, so if you put your K equal to D1 by P0 minus F plus G, how this formula your stands here? So this will be coming under working notes. 1 cost of capital, different source wise you have to calculate it. That is your D1 equal to expected dividend per shares. You see here expected dividend, you under dividend, you see that during the previous 5 years dividend have steadily increased from 10 to 14% per share. Dividend the end of the current year is expected to be rupees 15 per shares. So that is expected dividend per share. So D1 equal to your 15. Then what is the P0? P0 is the current market price, new issue price. So current market price you see that, and the new issue price they are telling here 125. So 125 minus then equal to your flotation cost. Flotation cost how much? They are 5 rupees they are telling flotation cost, plus your growth rate. Growth rate how much? G how we will calculate. So this G is little bit confusing part. So that G we have to understand here. How that growth rate we will calculate? G equal to growth rate, no? You see what conditions they have given. Dividend during the previous 5 years, dividends have steadily increased from 10.5 to 14.5 per share dividend at this thing. So that means growth rate over a period of 5 years. So your growth rate equal to root over 5, 14, 10 initially it was there, 14.19 it has been increased, 10.60. So this will be coming your 6%. So over a period of 5 years, 10.6 to 14.19. So this is your growth rate. So your this G figure will put there, that will be plus 6. So your that cost of equity K equal to will be your this way. This portions you calculate it 15 by 120 plus 6. So that way it will come your 18.50%. So 18.50% if it is there, then cost of equity will be your 18.50 means 0.185 we can write it. So your cost of equity comes here this way. So this cost of equity here we can write it 0.185 or 4 digit you can take it 1850, right? You understand that? Your cost of equity you got it. One by one we have to go for that. So this is the part you have to calculate properly. Now your portion is coming, your retained earnings. So retained earnings, cost of retained earnings, KR equal to your cost of retained earnings. Cost of retained earnings. What is that formula? D1 by P0 plus G. You see that these formulas you have to keep in memory, otherwise it will not be so much for this thing. Here also D1 equal to your shares price for these things, expected dividend per shares, that is your 15 rupees. 15 by P0 your equal to 125, that is new issue price 125, plus your growth rate equal to your 6%, 6. So that will be calculating your 18%. So 18% if you formula wise if you write per fraction point hisab se 1800, instead of 18% we can write this way 1800. So then your cost of retained earnings will be your 18%. So that we can write here 0.1800. So your retained earnings will be this. Now you have to see your preference shares. Preference shares. Then cost of preference share equal to your KP. So cost of preference shares your KP equal to cost of preference shares. So here this formula equal to KP equal to PD by NP into 100. What is the PD? PD equal to your amount of preference dividend, that is preference dividend is your 15%, preference dividend 15%. What is NP? NP equal to realized value of preference shares. What is that? Your realized value of preference shares, which is face value is 100 rupees, realized value is your preference shares equal to 105. So you have to simply put this figure in this formula. So your KP equal to this way, KP equal to PD equal to your 15 rupees, 15% divided by your 105, your that realized value of your preference shares 105 into 100. So this will come 14.29%. So if you take it in decimal point 0.1429, so this will be your preference share will be 0.1429, right? Your preference shares cost we have calculated. You see, next we have to go for your retained earnings. So retained earnings also, it is the accumulated profits for all the years, but even then it has some costs. So then you have to calculate the retained earnings over preference shares over now your debentures, cost of debentures. So cost of debentures, KD your cost of debentures, formula is your interest I 1 minus T equal to tax rate plus RB minus NP by N divided by RB plus NP by 2, where I equal to interest, T equal to tax rate, RV equal to your redemption value, and your NP equal to your net proceeds or market value. Net proceeds oblique market value. So similar way, if we put these figures in the above formula, how these things will come here? This way your calculations will stand. Your interest, this thing, cost of debentures, your 15%. So I equal to your 15. 1 minus tax rate is your 2, as you have given there 35%, 0.35 plus RB. What is the RB? Your A value, realizable value, that is 100 minus NP equal to net realized value, this thing. So here the figure they have given that NP also you have to calculate it. Then here we have to see, we have to start from market value. First market value to, we have to NP of debentures. So market value how much? MB, market value of debentures equal to your interest by market rate of interest, that is equal to your 15% of XO by 16%. So this figure is coming your rupees 93.75. So you see that interest 15% of 100 are, but market expectation is your 16%. So market value, your own interest rate divided by market rate of interest. So it is coming your 93.75. So that is the market value. But our problem, we want that market value place, we want your NP. That means net NP equal to your net proceeds, NP. So NP equal to your market value 93.75, and your flotation cost they are telling 2%. So 2% is your flotation cost, that is 2% of 100 rupees equal to your 2 rupees, then rupees 2 we have to minus. So 93.75 minus 2 equal to 91.75. So your NP equal to your these things. So 91.75. So how this your look like your this calculations part, it will be your this way your calculations will come 15 into 1 minus 0.35 tax rate plus 100 equal to your RB minus 91.75 by n equal to your 11 years, that terms, that divided by 11 divided by 100 plus 91.75 divided by 2. This is very simple, you can calculate it. 1 minus 35 equal to 0.65, 0.65 into 15, and this is 100 minus 91 by 11, some figure will come here. 100 plus 91, 191 by 2 figures, some figures will come. So that is coming your 10.95%. If you do in the decimal fact point 1095, so here cost of capital is 0.1095. So then cost of debentures will be your 0.1095. 0.1095. So now we can calculate it. Your these things weighted cost, how much it will come? Your this multiply weight multiplied by cost, that will be your 0.1138. Here also 154 by 18. Then this will be coming your 0.0277. Here also 185 by 0.1429, 0.0264, and last one your 046 into 1095, that is 0.0050. So this will be your these things weighted average cost of capital, and it is your these things weighted cost will be sum total will be your 0.1729. What you understand from here? Suppose you see that equity share cost capital is 11%, 11.38, and your these things retained earnings, your weighted cost is 2%, and preference shares 2%. Taking together overall it will be your these things 17%. So this way, this is the thing it is coming. So all this you understand that weighted average cost of capital by your book value method. So here you have to remember one thing, that is your cost of capital, all the source of finance you have to find separately. For that you have to keep it your memory formula in your memory. Once you calculate your cost of capital, after that things will become easy. So these cases you have been asked to two types of things. One is your book value method, another is your market value per shares method. So another alternative is there, calculations of weighted average cost of capital by using market value instead of book value. You must have noted down, it will be using market value of shares. So your these things market value of shares will change. You see that your market value of shares is 2 crores for these cases, equity shares and retained earnings. You see in these cases in your problem, here equity shares is 2 crores and retained earnings 0. So what you will be doing for this thing, what is your book value part? If you calculate the percentage here, you see that your other cases, your two different ways these figures were given. Your preference shares were 33,75,000 and debentures were your 10,40,000. This is market value, not book value. 10,40,000, and your equity shares were there 2 crores and retained earnings were nothing. So but when your equity shares and retained earnings are in the same group, what we will be doing, your 2 crores will be distributing ratio in proportions of your book value. So book value, your ratio was there, your 1 crore 20 lakhs and 30 lakhs, I think it will be there, it was there. So if it is there, that rate will be coming, so 2 crores divided into 120 by 150, so it will be coming here 1 crore 60 lakhs, and your return earnings will be 30 by 150 into 2 crores, it will be your 40 lakhs. You understand that? You see, here in case of your market value of shares, we are not giving, they have not given your return earnings figures. You have been given only equity shares value only. So if you see that, you are to distribute based upon your that face value, because see, return earnings, so this is the part of your that capital, no, ultimately it will increase your capital only. So we are taking the face value proportion, that 2 crores we have been distributed to the equity shares is 1,60,000 as per the weight of 120, and preference shares as per the weight of 40 lakhs, so 20 crores. And your weight also here will change. Once your composition of capital structure as per your this market value of shares changes, so definitely it will be change in your this weight also will be changing. So if you here also, if you total same one, here total figure is 2 crores 44 lakhs 15,000. So if you see that percentage 160 by 240, 2 crores 44 lakhs, so their ratio is coming 0.655, then this is coming 0.164, this will be coming here 0.138, this will be coming here your 0.043. You understand that? जो 1 crore 60 lakh, what percentage of 2 crore 44 lakhs? That is your capital structure distributions part. It is the total is 1. That means 65% from equity shares, 16% from return earning, 13% from preference shares, and 4% from debentures. Very simple. If you talk about percentage concept, then you see that cost of equity, cost of preference shares, return earnings, cost of preference shares and debentures, that will remain same. Only thing is that your weighted cost will change here, as because of that your weights have changed after taking into considerations your this market value of shares. So accordingly these portions only will be changing, and these figures will come here. This 6.65 multiplied by 18.50, this will become 0.1212, and this will multiplied by this thing 0.0296, and this will be your 0.0197, and this will be your 0.0047. So your total cost will come your 0.1752. You see that your capital structure, what is the difference for that? Your 17.5% your that weighted cost is coming, but individual if you see that equity share 12%, return earnings 2%, preference shares 1.97%, this thing. So here main issue is there in this capital structure. What you understand under from this weighted average cost of capital, your rates multiplied by weights. So that means whatever the amount of your investment, finally how much you are paying for your rate. So that is the vital issue. rather to calculate the individual interest rate. So that is the basic concept under this, because your rate might be slight changing 1%, 2% plus minus, but if your volume differs, so accordingly your rate also differ. So this is the point for your weighted average cost of capital. So today I think our discussions a little bit lengthy it is there, as because of that in single problem we have discussed all different source of capital and also your weighted average cost based upon your book value and market value. That's why this problem is a little bit our discussions also is lengthy, but no problem. This you can take as a master problem for that, and any of this problem it is coming maybe some portions of one part portions or two part or three part, whatever the case may be, you will be able to do that. So again, for everyday matter wise, I will be requesting once again to all, please do subscribe to my channel, as it is a new channel and your support is very much required. Unless and until you support, and this my energy and my enthusiasm will not be there to bring new videos before you. So last 3-4 days we have been discussing your cost of capital, and subsequently other chapters also will be going. We will be going your capital structure, we will be going in other capital budgeting decisions, short-term investment decision, long-term decisions. All those things will be will be going one by one. So we'll be ending here the video today, and please do once again request, please do subscribe and share to the videos to others, so that it will be well circulated to others, and I'll getting support from your end. So we are ending the video here. Have a good day.